Hi, welcome back. My name is Sani Hamid. I'm the Director for Economy and Market Strategy here at Financial Alliance. This is part 2 of an episode which is titled Market Continues to Underestimate COVID-19 Risks. In the last episode, we spoke about what we call the demand side, how we think COVID-19 will actually impact demand and how the market has underestimated this impact on demand. In this particular segment, we will talk a bit on the supply side. Okay, so we also think that the market has underestimated COVID-19's impact on the supply side and not only the demand side. Here, what I've done is I've put down all the previous crises over the past 20 years, and both the demand side destruction and supply side destruction of that entailed from those various crises. These are my own estimates. Basically, 1 refers to low impact, 5 refers to very high impact. I'll give you an example. In the Asian financial crisis, and in fact in all other crises, you'll find that actually most of the time you'll find that demand side destruction is the main thing, because asset prices fall, stock markets fall, people lose their jobs, so people don't demand goods and services, people don't spend a lot because they've just lost their jobs or they're worried about their jobs and so on, and the assets that they hold, whether it's property or stocks, have all depreciated in prices. So there is this demand side destruction, and you find that that's the most common type of destruction when it comes to crisis. When you talk about supply side destruction, that's less prevalent when it comes to crisis. You'll find that in most crises, factories can still produce. Factories still have stocks and components which they have in order to produce. It's just that they don't produce a lot because when they look at demand is not there. So they will reduce their production not because they can't produce, but because the demand is just not there for their goods and services. Okay, and that's not demand, that's not supply destruction. That's basically just following the demand side. But we did see a bit of supply side destruction in what we call the global financial crisis, or rather, we did not say a bit, but a bit more severe. In the global financial crisis, we had a situation whereby factories and the supply side was still ongoing. They could still produce, but they were unable to actually export some of their goods to buyers overseas because there was a lack of financing from the banks. The banks were not issuing loans, the banks were not issuing letter of credit, the banks were not issuing trade documents, and so on and so forth, because the banks were worried and very risk adverse. And because the middlemen did not do so, you will find that buyers and sellers could not deal in international trade because of the absence of the bank. So there was a breakdown in what we call the supply side, but more because of the financing in the global financial crisis. What's unique about COVID-19 is that both the demand side and the supply side, in terms of the destruction, in my view, is very severe. So it could potentially be what I term the perfect storm when it comes to demand and supply destruction for COVID-19. If you look at the demand side, it's very clear today, given the quarantines, given the worries of the consumer and so on, and they're not spending, they're not going out, travel has been curtailed, no one's going on holiday, and so on and so forth, and even the malls are empty. So straight away you can see that there is a very severe demand destruction, which you would not have seen probably in some of the other crises. Yeah, because again, empty malls, almost non-existent travel, companies cutting back on all business travels. This is really something which, even in my 20-30 years of working experience, I think this is quite severe what we're seeing today. On the supply side, it's quite unique because COVID-19 has caused what we call a disruption to the supply chain. It started off in China, China being one of the biggest manufacturers of components for many other items across the world, has caused a very severe disruption to the supply chain. In fact, a very interesting article from the Harvard Business Review argues that the major disruption to supply chain is actually coming by the middle of this month or later this month. Why? Because in February, when the factories all stopped working in China because of the quarantines, that did not disrupt supply, because in Europe and many other parts of the world, they had already gotten their supplies in January. In January, the Chinese factories were working. The Chinese factories were exporting and shipping these goods. These goods arrived in February to many of the factories outside of China. And in February, many of the ships were still going to various countries. But in February, everything came to a halt. The factories in China weren't manufacturing. The ships weren't leaving China because they had no goods to send to the factories outside of China. So basically, when it comes to March, you'll find that many manufacturers, factories outside of China, their inventories of stocks would have gone down to zero because they've used it up, and there's no resupply from China because China was basically closed in February. So the argument is that in March and probably even in April, you'll find that many factories in Europe and many parts of the world, in the US and even Southeast Asia, will find it difficult to continue with production at normal capacity because of the lack of raw material or the lack of components from China itself. So that's left to be seen, but I think the argument is quite solid. So again, you will see a supply side disruption, which will be ongoing, in my view, over the next couple of months. And the supply side disruption isn't just about not enough components from China and so on. It's also about something called a labor shock. A labor shock basically is when there's an absenteeism of staff, factory workers, either because of illness, that they've got the virus unfortunately, or because of fear of going to work, or because one staff had it and the whole company has to close down or at least go into quarantine. So that itself is a labor shock, and even if you have the components, production still comes to a stop. So basically, this in itself is another hit to the supply chain, in my view, and this is something quite unique to COVID-19 compared to the other risks, compared to the other crises that we've seen over the past 10-20 years. So in essence, this supply chain disruption is not just a China problem. A lot of people argue, since China now is restarting its factories, is starting to export again goods and components, everything will be okay. Well, the problem is this: while China has restarted and is starting to send out components to other parts of the world, the other parts of the world are the ones now facing this shutdown, quarantine, absenteeism risks. Meaning to say that, so the rest of the world is the one today which will be shutting down and not able to produce, despite the fact that China has started production again. And this will continue over the next 2-3 months as the virus makes its way into Europe, into US, into the rest of the world. So this shutdown risk is not just confined to China. This shutdown risk now is permeating to the middle stream of the supply chain and not just the front end of the supply chain where China is. And one more thing is China, having successfully actually mitigated and shortened the epidemic curve, and this is a fact, which is very impressive. They have actually given the world the blueprint, meaning to say that even the WHO acknowledges, if everybody follows what China is doing, then basically the epidemic curve, or this virus, the epidemic curve will not be the usual 6 to 9 months, but can be cut short to maybe 2 or 3 months. The only problem with that is that we all know that the Chinese blueprint has a price, which is economic activity, because it requires very hardcore type of quarantines. These are quarantines which many countries just cannot follow, or can only follow in piecemeal type of ways. But we are hearing countries suggesting so. Italy had a lockdown of towns, I think a dozen or more towns. In the UK, which recently just released a blueprint, they are saying they could even force entire cities to shut down. And all of this will result in economic activities actually stagnating. So this is actually, again, without economic activity, the supply chain will be impacted. And when it comes to the economic data, I think the Chinese data that has come out for February, because we're in March now, so we're beginning to see data being released, macroeconomic data. This is really the one that has come out to scare the authorities, central banks and governments, because when we look at the data, it's really bad. If you look at the Chinese service sector, manufacturing sector, these are the charts. All of them have just virtually come off a cliff, and there are signs that it's being permeated into other countries, even like Singapore, South Korea, and this is no surprise. But when the shutdown of risks of factories and economic activities permeates to the rest of the world, don't be surprised if the data from the rest of the world also starts to show very significant deterioration. So in summary, well, we think that the market has underestimated what's coming ahead for a second time. So the first time was it treated COVID-19 as SARS and confined to China, which it got it wrong totally. Right now, we think that there are several things that the market has underestimated. One is the huge jump in the number of global infected people ex-China in the next couple of weeks. We think that number is going to go up very high, very fast. That's going to scare the consumer. That's going to have a psychological impact on the consumer. We think that the shutdown risk, supply chain disruption, will have a major impact on companies, not only in terms of not being able to produce, but also falling consumer demand. So earnings will be hit for companies, and we don't think this has been discounted this has been discounted enough in the markets. We think that the macroeconomic numbers, when they start showing up on the headlines, will also have an impact on the consumer. When they start seeing things like economic activities, GDP, and so on and so forth showing really very bad numbers, they will start to worry. And eventually, who knows, there could be potential systemic risks, because this is really a slowdown in economic activity that we've not seen since the 2009 crisis. Some companies will be affected. As it continues, don't be surprised if some of them actually fold, close down, declare bankrupt, and so on. So we could have some what we call systemic risk coming from there. So, having said everything, is there any good news? And the answer is yes, to a certain extent. We think that after stage 3, there could be a bit of stabilization in the markets. Why do we say that? Because if the markets start to come off another 5, 10, 15%, what it means is the market has discounted a lot of what I've just mentioned. It has failed to do so far. That would have been discounted. So that would be a good thing. But when we reach this point here, in all likelihood, the global total infected rate count would have also moved up the curve to somewhere, let's say around X. This actually, if this trend continues with, and this is assuming that the virus doesn't mutate and so on and so forth, you'll find what the market does is the market will start looking forward, and the market will tell itself, this is a bell curve. Even though I'm here at X, what will happen is this thing will peak out in the next 1-2 months, and it will start to come off, and this thing will go away maybe in about 3 to 4 months time. So I think once the market has discounted all the items I've mentioned earlier, and it's done that already, the next phase it will start to discount the future. And when it looks into the future, it will be encouraged because there is this particular path that is quite predictable. So that's where I think we will get some form of stabilization in the market. Further out from there, really the market moves into 2 paths. Either you're like us, where we worry that this COVID-19 will lead to so-called systemic risk and the beginning of the dominoes, then that would lead to the markets going down lower from there. But we do admit there will be people who think that the markets could be business as usual, and thereafter, post-COVID-19, the markets will move higher according to this blue line. They will be. So I guess let's not make that assumption now, let's just say that we are pretty certain to a large extent that we will see a stage 3 where markets have underestimated a whole bunch of things, and then after that we could see a form of stabilization. I think visibility is probably quite good up to this extent. So putting it in a chart, this is the S&P 500. S&P 500 is, we've not updated it for the past 1-2 days here, but there's some volatility here. But if you draw a trend line, what you'll find that the S&P 500, all the way from the beginning of the crisis in 2009 up to today, there's this particular trend line. We won't be surprised if actually prices move all the way back down to that trend line, which is another 10%. And again, this is just trying to infer what will happen to other markets. So basically there's about a 10% downside potential for markets, bringing the total decline from top to bottom to about 20%, which is quite normal in terms of a retracement. Okay, and from there on, if you're in our camp, you will worry about what we call the triggers for a systemic risk and so on and so forth. But that again is left to be seen. The short term is more predictable than the long term at this particular point. Okay, fairly long, but I hope you kind of understand where we're coming from. Overall, we think the market has yet to fully digest and fully discount the risks emanating from COVID-19. We hope you liked our short video. If you do subscribe, we'll come up with more, and I hope to see you at another time. Thank you.